Right, let me tell you something that's going to make you sit up and pay attention. Over the next 18 months, close to 1 million homeowners across the UK are going to receive a letter through their door. And that letter, it could genuinely force them to sell their home. The mad thing is, most of these people are walking around right now thinking everything's absolutely fine. Whether you own property, you're trying to get on the ladder, or you've been renting for years wondering if you'll ever afford a place of your own, what I'm about to share with you today is going to completely change how you see the housing market in this country. Because what's happening right now isn't just a bit of a slowdown. This is a complete reshaping of who actually gets to own property in Britain. And by the time we're done here, you're going to know exactly which side of this divide you're standing on. So here's what nobody wants to talk about openly. The UK property market has basically split clean in half, and the two sides are heading in completely different directions. Head up to places like Newcastle, Leeds and Manchester, and houses are flying off the shelves faster than they have in years. We're talking about properties going under offer within a week, sometimes less. Multiple buyers scrapping over the same house. Prices in the northeast have jumped nearly 8% in just 12 months. But down south, London and the southeast, it's like someone's pressed pause on the whole thing. Asking prices are drifting downwards month after month. Sellers are sat there watching their properties gather dust on Rightmove, and the ones who do manage to get offers are having to accept way less than they'd hoped for. Think about that for a moment. A 3-bed house in Newcastle might set you back around £180,000. That exact same house in outer London, you're looking at £450,000 or more. The gap between what property costs in different parts of the country has become so extreme that people are genuinely asking themselves whether staying in the south is even worth it anymore. And this isn't about fancying a change of scenery or wanting a different lifestyle. This is pure maths, forcing people's hands. The average salary in London is higher, sure, but it's nowhere near high enough to justify mortgage payments that are double or triple what you'd be paying further north. When you factor in commuting costs, council tax, and just everyday expenses, someone in Manchester with a £200,000 mortgage is genuinely living better than someone in London struggling with £400,000 and an hour-long commute each way. And buyers are finally cottoning on to this reality. The data tells the story. Supply in London has shot up nearly 19% compared to last year, more and more sellers flooding the market trying to get out. But actual transactions, the sales going through, those are down 28% year on year. So you've got all these people listing their properties, but nobody's buying at the prices sellers want. That creates a standoff, and in a standoff like that, there's only one direction prices can go. Now here's where things get properly serious, and this is the bit that's going to affect hundreds of thousands of families directly. Between now and the end of 2027, roughly 800,000 homeowners are going to watch their fixed-rate mortgage deals expire. These are people who locked in rates at 2%, maybe 3%, back when borrowing money was basically free. Now they're coming off those deals and staring at rates of 5% or higher. Let me make this real with actual numbers. If you borrowed £250,000 at 2%, your monthly payment sits around £1,120. Not too shabby. But when that deal expires and you have to remortgage at 5%, that same mortgage suddenly costs you £1,460 a month. That's an extra £340 every single month. Over £4,000 a year extra for families already stretched thin with energy bills, food prices, and everything else going up. That's not just uncomfortable. For many people, that's simply unaffordable. And if you think that sounds rough, here's what makes it worse. If you don't remortgage and just fall onto your lender's standard variable rate, you could easily be looking at 7 or even 8%. At 7%, that £250,000 mortgage is now costing you £1,750 a month. You're suddenly paying over £600 more than your old deal. That's over £7,500 a year just in extra interest. Nothing else has changed except the rate. For tens of thousands of homeowners, especially those who bought at the absolute peak in 2021 or 2022, this simply isn't sustainable. They stretched every penny to afford the property when rates were low. Now they're facing an impossible choice. Find an extra few £100 every month somehow, or sell up before they're forced into an even worse position. This is exactly why we're seeing supply increase so dramatically in certain areas. It's not that people suddenly fancy moving, it's that they literally have no other option. But here's what makes this whole situation even more brutal. There's a massive generational divide happening right under our noses. If you're over 65, there's a 61% chance you own your home outright with no mortgage. You're sat there watching your property value tick up slowly, no monthly payments to worry about, life's comfortable. But if you're under 45, you're almost certainly carrying a mortgage, and you're feeling every single rate rise like a punch to the gut. Younger homeowners are holding the bulk of the UK's mortgage debt, which means they're getting squeezed the hardest. This isn't about pointing fingers at different generations. It's just the reality of when people bought and under what economic conditions. But what it does mean is that the pain of higher interest rates is concentrated almost entirely on one specific group. And that group is now flooding the market with listings because they physically cannot afford to stay. Now let's talk about landlords, because this is where things get really interesting. Last year, 19% of landlords sold properties. Compare that to just 8% who actually bought new ones. That's a massive net loss of rental stock. Recent surveys show that 41% of landlords are either planning to reduce their portfolios or exit the market entirely within the next few years. Nearly half of all landlords are considering selling up and getting out. Some are just tired of the hassle, but most are being forced out by economics that simply don't work anymore. Mortgage rates have more than doubled for landlords too, and they can't just pass all that cost on to tenants because there are real limits to what renters can actually afford. Then pile on all the regulatory changes coming through. The Renters' Reform Bill is shaking everything up, and loads of landlords simply don't want to deal with it anymore. The bill scraps Section 21, meaning landlords can no longer evict tenants without a specific legal reason. That might sound brilliant if you're renting, and in many ways it is. But from a landlord's perspective, it adds serious risk. If you end up with a problem tenant who stops paying or trashes the place, it's now much harder and more expensive to remove them. Then there's the furnished holiday let changes coming in April 2025. All the tax benefits that made short-term rentals attractive are being stripped away. Landlords relying on those perks are looking at their spreadsheets and realizing the numbers just don't work anymore, so they're selling, often to people who want to live in the property themselves, meaning those homes are leaving the rental market permanently. What's absolutely wild about this landlord exodus is it's creating two completely opposite effects at the same time. On one hand, rental supply is shrinking, pushing rents up. Tenants competing harder for fewer properties. On the other hand, all those former rentals hitting the sales market are adding to supply, pushing house prices down in some regions. It's this bizarre situation where renters are paying more while house prices are falling. But here's the fascinating part. While the overall market is clearly struggling, there are still pockets absolutely thriving. Cities like Manchester, Bristol and Glasgow are seeing serious growth. Buy-to-let mortgage applications actually surged by 32% in early 2025. While nearly half of landlords plan their exit, there's a smaller group of professional investors actively coming in, buying properties at reasonable prices with yields hitting 6 to 7%. The North and Midlands are where the smart money is flowing. You can still buy a decent two-bed flat in Liverpool for under $120,000 that'll rent for $800 a month. That's an 8% yield before costs. Compare that to London, where you might pay $400,000 for a flat renting at $1,800. That's barely 5% gross. After all your costs, you're lucky to see 3% net. The numbers down south just don't work for new investors anymore. First-time buyers are starting to see real opportunities too. With landlords selling left and right, more properties are available. Some sellers are desperate enough to accept lower offers than they would have 6 months ago. If you've saved a decent deposit and can secure a mortgage, you actually have negotiating power right now. Properties listed at $300,000 6 months ago are quietly being reduced to $285 or $280. That's real money saved just by being patient. What nobody's talking about enough is the sheer collapse in transactions during certain periods. There have been months recently where activity dropped over 60% compared to the previous year. That's not a slow market, that's a market frozen solid. Buyers don't want to commit because they're worried prices will keep falling. Sellers won't drop their asking prices because they remember what next door sold for in 2021. Everyone's waiting for someone else to blink first. Then there's the Help to Buy aftermath. Back in 2013, the government launched the equity loan scheme to help first-time buyers. The problem was it only applied to new builds, so buyers were funneled toward developers who knew they had a captive market. Many developers added a premium to prices, sometimes 10 or 15% above actual value. Now fast forward to 2025, and loads of those buyers are discovering their properties haven't appreciated as expected. Some are worth less than what they paid. Imagine buying a new build flat for $250 with Help to Buy back in 2017, paying your mortgage for 7 years, then finding out it's only worth $230. You've less equity than when you started. That's reality for thousands right now. So what's actually going to happen? Most analysts predict modest growth in 2025, maybe 1% nationally. But longer term, things get interesting. Savills forecast total growth of 24% over the next 5 years. That's nearly a quarter more in value. The theory is straightforward. Wage growth is expected to average around 2% annually by 2029. As people earn more, they can afford higher payments even if rates stay somewhat elevated. The Bank of England is expected to gradually reduce the base rate to around 4%, bringing mortgage rates down to maybe 5% for decent deals. As rates stabilise and wages grow, confidence will return and transactions will pick up. The opportunity window for buyers and investors is right now, during this period of uncertainty when everyone else is frozen. If you're a first-time buyer who's been saving, this is arguably one of the best times in 5 years to make a move. Yes, rates are higher, but prices are lower than they'd otherwise be, and you have negotiating power for the first time in ages. If you're a landlord, make an honest decision about whether you're in this professionally for the long term. The days of easy money from property are over for now. If you can't make the numbers work at 5% with increased regulation, selling might be the right call. But if you're genuinely in it for the long haul with solid properties and good cash flow, riding out this period could position you brilliantly for the next cycle. What we're witnessing is a fundamental reshaping of property ownership across the UK. The generation that bought cheaply in the 80s and 90s now sits on massive equity and owns outright. The generation trying to buy now faces the highest prices relative to wages in modern history, combined with elevated mortgage rates. This creates a wealth transfer where ownership becomes increasingly concentrated among those who already own, while younger people struggle to get on the ladder at all. But within every crisis, there's opportunity. The regional divide means genuinely affordable areas exist with real growth potential if you're willing to look beyond London. The landlord exodus means properties are available that weren't for sale 2 years ago. The mortgage rate shock means motivated sellers creating negotiating opportunities. The key is understanding the market properly, knowing your numbers inside out, and being ready to act when the right opportunity appears. The UK property market of 2029 will look very different from 2019. The cheap money era is over. The new market rewards those who do their homework, understand the numbers, and spot value where others see only risk. It punishes those who buy emotionally, overpay out of desperation, or assume prices only go up. So whether you're a homeowner hoping values hold, a renter wondering if you'll ever buy, or an investor hunting